Welcome, everyone, to our October 2024 monthly market update by Kingdom Focus Financial. Today, our speakers will be once again Michael Smith and Chuck Etzweiler. Take it away.
Hey, thanks, Derek. It's good to see you. Thanks, everybody, for joining us for this month's update. Looking forward to just sharing a little bit of information related to the market that we think is really, really relevant due to the timing of where we are in this year. Chuck, once again, it's good to have you here. Thanks for joining us.
My pleasure, Michael. Thanks for having me.
And as usual, our friends from compliance require that we also include them. And so I'm just going to remind everyone that what we say today is our thoughts and opinion and commentary, and it's not meant to influence your portfolio in any way. If you have questions about your portfolio, give us a call and we'll talk to you about your individual investments. In fact, today we're going to take a little break, right? So we've been talking all year about our theme, our four theme, and in previous months' videos, we've driven down into each of these topics. And so if you missed any of those, I would encourage you to go back and view those so you can get an understanding of where Fed policy came into play and wow, that has impacted us for this month as we finish moving forward through the rest of the year, where oil came into play and how we're watching the US dollar and the concept of reshoring and that jobs market and unemployment number. So go back and take a listen to those. Today, however, we're going to take a little pause because we've got this thing called an election right in front of us, Chuck, right? And
Yes, we
we've
do.
been talking all year along the way about how the market is really neutral when it comes to presidential elections, but we thought we'd dive in a little deeper to talk about, do the markets really care? And if so, what do they care about when it comes to presidential elections? And so that's our intent today in the next couple of minutes. Just wanted to share some data that helps you understand what does it mean when you hear in all those different places you may get news and information about the markets being neutral related to the presidential election. Chuck, explain to us what we see here.
Most certainly, Michael. So we want to try to answer that age-old question that's asked to us, probably number two behind what about the national debt is which party, Democratic or Republican, is better for the stock market, at least the person sitting in the Oval Office. So here's what we did, Michael. We asked Bespoke to go all the way back to 1901. Reason being the Dow Jones Industrial Average was created in 1897. So literally we have 125 years of data all the way back to Theodore Roosevelt. And here's what we did a little differently, or we had Bespoke do on our behalf, Michael. We said, let's start at the day of inauguration. And why is that important? As opposed to the day the president's elected, that could be in November. They don't start serving until January. So they're not on the clock. They have the bully pulpit as of January 20th, right? And what they can do is influence policy. They can sign executive orders. And let's keep that rate of return constant until the day that they leave, not the day that they lost an election or maybe they served their two-term limits. And we think that's a much better gauge. So all in all, what does it mean, Michael? I think if you take your cursor, you go all the way down to that bottom median white number, you'll see 7.7, or I should say white column. So what is that? That's the appreciation, the median return, which is the best way to measure data over a long period of time. But Michael, scroll down a little there and you see median Republican 7.9, median Democrat 7.7. These are rounding errors, Michael. So I would like to just suggest that maybe this answers the age-old question. However, in a couple of slides from here, we're going to talk about policy and how any candidate who got elected into office, and this is not necessarily something wrong, but they were supported by industries, businesses, sectors. It's our job, Michael, to unearth how that particular policy is going to relate good, bad, or indifferent to a given company. So the overall returns are consistent. However, how that return is garnered and where it comes from is different. And that's what we're going to speak to today when we get to that last slide.
Perfect. Yeah. And I should let everyone know, I know what's coming because we put it together, but this one really gets at the top tier And we're going to drill down. And what we've done today is kind of broke it into three specific layers that I think the markets do care about in some respect. But at the top layer, you'll notice this is also the Dow Jones Industrial Average numbers that are here, one measure of the US economy. And it is absolutely true statistically that the market doesn't care which party is in office in the White House when it comes to the overall economic numbers over time. But let's drill down a little bit and take a look at what it means at the lower level. Where does it start to care?
Now, Michael, if you to look at this chart, you'd say, "Oh my, it's really busy," right? So I'm going to do my best to explain how we've unearthed what this actually means. Again, our friends at Bespoke put this together on our behalf. So they went all the way back. Again, if you look up at the top banner, 1901. Again, as you just noted, the Dow Jones Industrial Average. Again, we nearly have 125 years of data. And we've heard this old adage, Michael, right? That, oh my goodness, gridlock is good. The stock market likes gridlock. I don't know if that's necessarily true, first and foremost. And I think the chart bears this out. So what do we see here? I think if you go up, Michael, to the triple D, right, that's what we call the blue wave. So the blue wave has occurred 21 times. And again, the house serves 2-year terms. So you multiply that number by 2, you get 42 years. And if you look at that top row there, Michael, the annualized return is 7.4%, 44%. And if you just go again to the right, the percentage time that it's up is 2/3. So that's the number one most common outcome. Now, Michael, if you go down to the triple R, that would be the red wave. That's the second most common occurrence, right? 14 times. So take that and multiply it by 2, you get 28 years. And then, Michael, scroll over to the return. Again, you see 7.94% annualized, and you see the 78.6. So again, what is this saying? And I think that the financial press, for some reason, doesn't either understand this or maybe it doesn't tell the story as they want. But when you have, and you and I were talking about this in the green room, because I love you to add in here that when you have one pathway delivered either in blue or red, you're going to get a more definitive outcome, and the market can price that in. So you get these consistent high returns when you have a blue or a red wave. So I'd like you to just kind of comment on that, because I love what you were saying in the green room again prior to us going live here.
Yeah, and I think what this, for me, tells us about the market is it doesn't really influence the overall economy out of the White House, but it does matter when one party or the other has the ability to actually affect their ideas,
You
right?
got
And
it.
so when we talk about that gridlock, it's good, people say all the time, meaning things aren't going to pass or get through and we're going to stay status quo. Well, over time, status quo is really not good, right? We have to be growing as a country. We have to be improving. We have to be modernizing. And so we do need
Exactly.
those periods where things happen. And I think this, if you dive into the statistics, for me, my interpretation shows that there are times where it's possible in gridlock that things get done. And certainly in every gridlock session, some legislation passed, but it's most likely just floating back and forth. But when one party controls the House, where a lot of policy gets started, and the Senate to approve or tweak and send it into the White House for that final signature, more tends to happen when they're in complete control. Call it easy street when it comes to passage of legislation. And when we look at that, I think it does start to tell us a little different story in that it has an impact. We start to see some divergence in numbers in
Exactly.
terms of overall return within different pieces or different types of legislation. And so I think for me, while the presidential election is important when it comes to moral and ethic and values related to what our founding fathers established and what we want our kids and our grandkids to experience as they grow up in today's world, we need to be paying attention to who our congressmen and House of Representatives are when it comes down to economics, more so than the White House.
Absolutely.
Yeah, layer two, but let's drive down a little bit more. Things that are I think, more important to related to our portfolios and what matters to us and our clients as we're looking at economic pieces. And in that vein, I want to highlight specific sectors of the economy. You mentioned it at the beginning that whoever is in the White House is supported by different industries. Well, why? Right? Well, I'm going to go back to my statement I like to make: follow the money, right? They're often supported because what the White House can do is influence the House of Representatives and Congress in sectors and saying, we want action here, right? And do my bidding, so to speak. And what's interesting to me is this is where we really start to see that separation come to play in politics and the economy and how they integrate. And I want to start by looking at just, we highlighted several pieces, but here, this orangish line, US value, look at this US market, not worldwide, but the US market, how similar these numbers are. This goes back to that first slide. It talks about how the general return, remember, it's measuring the Dow Jones, kind of a broad-based index. Yeah, the US economy kind of chugs along at this pace, regardless of who's in the White House, but it's prudent to pay attention to the things that wrap around that mainstream economy. Talk to us a little bit about the specific pieces of this chart.
Certainly. So maybe what I'll start out, Michael, right where your cursor is, kind of that royal blue, I guess the third from the top. Under both presidents, the S&P 500 has had an upward trend and a better than average return, 16 for former President Trump and 12.4 for current President Biden. So there's opportunity, but it's been in different colors and stripes. Look at commodities up in the upper right-hand corner under President Biden. Obviously, in his regime, we've had inflation. There's always opportunity, Michael. And yes, inflation erodes purchasing power. But if you look at commodities, whether it's energy or gold or agricultural, they are up. And they've actually had the highest rate of return of any of the assets in the Biden administration. If you look to the left and you see the green under former President Trump, you see U.S. growth. Part of that is due to tax cuts, which certainly help businesses. The corporate tax cut, it went from 35 down to 21. You can make the case that that ended up spurring growth. I would simply say that even despite the tariffs that were put on China, which people would think was a death knell to emerging markets, if you go all the way down to the bottom, emerging markets actually outperformed under the Trump administration versus when Joe Biden has been president. The other thing is that if you look at bonds, the bottom three, you got the blue and the orange, negative under, again, Joe Biden. Part of that is because of, again, inflation, and you see positive for bonds. The last one I want to mention is the gray one, U.S. small companies. We know that there was a tax cut that included small businesses. Small businesses tend to do better under a low inflation regime. So there is a divergence there. So it's amazing, Mike, when you look at, again, the S&P 500, both have really good numbers, but the composition of that number is different for both of these. And this is our job, Michael. This is why there's opportunity always, whoever is in office, but it's going to come from different areas. And what we have to do is vet those policies and then determine which sectors, industries, asset classes will benefit or won't.
And that influences the pieces we hold in our portfolio then as we're looking forward to the next 4 years. Now, before anyone gets all up in arms, I want to step back and just say, why did we pick Trump and Biden for this slide? This isn't a political message in any way, but it's a reality of who was voted on in the primaries, right? And in this case, as compared to many others, we really don't have any new faces in this presidential race. Trump had 4 years as a president. Biden had 4 years as a president. And so we're able to compare head to head what has happened under their leadership during those timeframes. Now, I understand the current candidate in the Democratic Party is someone different that was inserted in there, but not voted on in the primary. And they did that under the understanding that they were running on the same platform. So we're going to make the argument that it's really the current candidate is really the Biden policies. And that's why we compared them head to head in using this slide. Now, what's interesting, though, is looking back in history, because this is intriguing to me, we do start to see a divergence by party based on different sectors of the economy. Maybe another time we'll dive into that. We're about out of time for today. But I thought this would be helpful for everyone to start to understand the different layers of where it starts to have an impact and how it may affect them. I think what's most important in wrapping this up is just for everyone to understand that the presidential election really comes down to policy. It's that value, what you want to see happen in our country, things such as tax policy, right? Trade policy. Those are influenced by what they say they want because they're directing the House to craft legislation to update or change those things. So, as always, I want to thank you for watching, for being here. I hope you found this helpful, a little break from normal market data, but something that's really relevant as we face that upcoming election here within the next month. I want to encourage everyone to get out and vote. That's one of the great benefits of the free country that we live in. Please don't sit at home. If you do, get your mail-in ballot and send them in. But think about what you want to see happen in the future and take advantage of that opportunity to go out and express your voice and your opinion in the upcoming election. And I look forward to seeing you out there at the polls. Thanks again for working with us. We enjoy the confidence that you give to myself and our team, and we'll look for you next month. Thanks.